Just like customers return merchandise from time to time, businesses return merchandise as well, or granted purchasing returns or allowances for defective merchandise, or payment discounts for paying early. In this video, you'll learn how to record purchases, returns, and allowances, as well as purchase discounts, and I'll go over several examples for these transactions. When merchandise arrives, an authorized person should confirm that the merchandise is satisfactory and meets quality standards. Occasionally, the wrong goods are shipped, or items are damaged or defective. That can happen. So what does a business have to do in such a situation? The company contacts the supplier for return authorization, and if the supplier agrees, they issue a credit memorandum for the return once the supplier receives the returned goods. That process is called a purchase return. A purchase allowance is a bit different in that the purchaser keeps the goods but receives a reduction in the price. So for purchase returns, the product is returned and a refund is issued via a credit memo for the entire amount of the return. In the case of a purchase allowance, the merchandise company keeps the goods because perhaps they are still good enough to sell or use, but receives a reduction in the price. For accountants, it's important to know that purchases, returns, and allowances are entered in the purchases, returns, and allowances account, not in the purchases account. If we were to record the returns and allowances in the purchases account, we wouldn't be able to easily tell how much the merchandise company had in returned and defective goods. The purchases, returns, and allowances account is a complete record of returns and allowances. And business managers analyze this account to identify problem suppliers. That's an important analysis that accountants should look at as well. Returns and allowances waste the company's resources because it's expensive to return and reorder products, issue credit memos, and on top of that, accountants have to record additional transactions. So if there are problem suppliers, you would want to understand what is going on and if the company should look for new suppliers. Before we look at the example, I want to mention that purchases, returns, and allowances is a contra expense account, a subcategory under cost of goods sold on the income statement. The normal balance of cost of goods sold accounts is a debit. However, the purchases, returns, and allowances account has a normal credit balance. So here's an example on how Max Out Sporting Goods records purchases, returns, and allowances. Let's read it together. Max Out Sporting Goods received merchandise costing $4,760 from Modern Sportsman on January 15th, invoice 1100, with freight charges of $360 paid by Modern Sportsman and added to the invoice. Some goods were damaged and the supplier granted a $476 purchase allowance on its credit memo 103 of January 27th. This reduction price reduces our accounts payable, and that is why we debit accounts payable when we receive the credit memo and we credit purchases, returns, and allowances. When Max Out Sporting Goods pays Modern Sportsman, we debit accounts payable for $4,644 and credit cash for the amount of the original invoice, $5,120, less the credit memo of $476 or $4,644. Do you recall when we discussed net 30-day payment terms? Just as a reminder, it means that the invoice must be paid in full within 30 days. Suppliers want to receive the money sooner, though, and often offer a price reduction called a purchasing discount, and merchandising companies that are buying goods and services are interested in receiving purchasing discounts, not to be confused with trade discounts. Trade discounts are discounts that are typically granted based on the volume purchased. For instance, if you purchase 500 of this product, the price decreases by 20%. If you purchase 1,000, the price decreases by 30%. That's a trade discount. What I'm talking about here is a discount for paying early. A popular purchase or payment discount is 2% 10 days, which translates into this. The buyer can reduce the invoice amount by 2% if the buyer pays the bill within 10 days. There are other similar terms such as 3% 10 days or 1% 10 days or 2% 20 days. They all have this in common. It is a discount offered by suppliers to encourage expedited payment by customers. Just keep in mind that the 2% discount does not apply to freight prepaid by the supplier and added to the invoice. Let's look at this example. Max Out Sporting Goods received merchandise costing $3,000 from Modern Sportsman on January 10th. Invoice 880, terms 2%, 10 days, net 30, with freight charges of $200 paid by Modern Sportsman and added to the invoice. Max Out Sporting Goods recorded the purchase as follows. We write the date into the date columns, purchases into the description column, and a debit of $3,000 in the debit column. On the second line, we debit freight in for $200. And on line 3, we slightly indent and credit accounts payable for $3,200. Max Out Sporting Goods now pays the amount due after deducting the 2% discount on January 19th with check 150. The amount due is $3,140, which is $3,000 plus $200 for freight minus 2% discount of $60 for a total of $3,140. The payment is then recorded by debiting accounts payable for $3,200, crediting purchasing discounts for $60, and crediting cash for $3,140. Why do we not record the purchases discount right away when we record the invoice? Because you don't know for sure if you're going to take advantage of the discount until you actually make the payment. So why is it so important to take advantage of the discount? Well, if you annualize the discount, you begin to understand how much the trade discount really is. You're receiving a 2% reduction simply by paying 20 days earlier. So 2% for 20 days. The alternative is to leave the money in the company's checking account where you would likely not earn any interest, or put it in a high yield savings account. But even there, the interest is only about 3 to 4%, but that percentage is for an entire year. 2% for 20 days annualized is the equivalent of 36.5%. So if possible, and if the company has sufficient cash, it should always take advantage of the purchasing discount. So what happens if there's a purchase return, and a purchase discount? If there's a purchase return processed within the discount period, the buyer is entitled to take the cash discount only on the balance owed after deducting the return. For example, assume a $500 purchase from Modern Sportsman on January 11th, terms 2%, net 10 days, net 30 with freight of $25 added, invoice 910, and a return of $100 on January 12th, credit memo 112, and the final payment on January 20th, check 149. The merchandise purchase of $500 with freight of $25 added to the invoice. So we'll record the purchase with the debit of $500 to the purchases and a debit to freight in for $25 and a credit to accounts payable for $525. The purchases returned below reduces accounts payable by $100 with the debit to that account and credits purchases, returns, and allowances. Why do we record this in a separate account? Well, it's really helpful for analysis of how significant returns and allowances are to your business. If your purchases and returns are really high, then you probably want to figure out if you should change suppliers. Now we're ready to record the payment on January 20th within the 2% 10 days payment terms. First, let's figure out how much has to be paid. We take the original invoice of $500 and add the freight of $25, deduct the return of $100, and then deduct the purchase discount of 2% or $8 for a total of $417. We'll record the transaction with the debit to accounts payable for $425, a credit to purchases discount for $8, and a credit to cash for $417.